So let's talk about Nvidia. I mean, they're the absolute king of the AI revolution, right? They're powering pretty much everything. But if you've been watching their stock lately, you've probably been scratching your head because after this just incredible meteoric rise, things have gotten a little weird. And that's exactly what we're going to unpack.
So this is really the big question, isn't it? Their AI dominance is totally undisputed. Demand for their chips is just, completely off the charts. The business is firing on all cylinders. So why in the world has the stock suddenly slammed into a wall? Let's dig in and see what the numbers are really telling us.
You see, to really get a handle on this debate, you have to look at the stock's performance through two different lenses. Because depending on how far you zoom out, you get two completely different stories. And honestly, they almost contradict each other.
Okay, check this out. Over 5 years, we are talking about a mind-bending 1,200% return. That's 13 times your money. Unbelievable. Even just in the last year, a massive 71% gain. But then you zoom in on just this year, and it's actually down 3%. And that right there, that's the friction point. That's where this whole debate about Nvidia's true value really gets started.
So let's start with the first side of the argument, the cautious view. This is the perspective that says, hey, after that insane run, maybe the stock got a little bit ahead of itself. And this whole idea is built on something called a fair value model, which tries to figure out what a company is actually worth based on its future potential.
Okay, so first things first, let's get our bearings. The stock is trading right now at about $182 a share. Just keep that number in your head.
Now, here's where it gets really interesting. According to one popular and very detailed financial model, Nvidia's fair value is actually around $170. That's right, it's below where the stock is currently trading. So you do the math, and according to this one specific model, the stock is about 7.3% overvalued. But here's the kicker. What kind of assumptions do you have to make to arrive at that number? This is where the story takes a really fascinating turn. So get this, for the stock to be considered even a little overvalued, the model already assumes some absolutely wild stuff. It assumes Nvidia's gonna hit $400 billion in revenue in just 5 years. It assumes that data centers around the world will add 4.5 gigawatts of new power capacity every single quarter. To put that into perspective, that's like bringing 3 huge nuclear power plants online every 3 months. So the craziest part is, even the bearish case for Nvidia is built on a foundation of absolutely explosive, world-changing growth. It just suggests that the stock's price has somehow managed to outrun even that incredible future. Okay, so let's flip the coin. Let's move to the other side of this debate and see how they built a completely different picture. This is the bullish case, the one that argues the stock isn't just fairly valued, it's actually getting ready to double. And we're not talking about a quiet whisper here. As the Motley Fool puts it, calling for one of the largest companies in the entire world to double in value is a huge, huge call. But they believe Nvidia is set up to do exactly that. So how on earth do they get there? Well, the bullish case really leans on a different tool, the forward price to earnings ratio, or forward PE. It's actually pretty simple. Instead of looking at today's profits, you're looking at the stock's price tag compared to what the company is expected to earn down the road. And generally, a lower number here can be a sign that you might be getting a pretty good deal. And this right here is the heart of the whole bullish argument. For the past couple of years, investors have been more than happy to pay 40, even 50 times Nvidia's future earnings to own a piece of it. But today, that number has been cut in half. It's down to around 22 times. And this is all happening at the exact moment their earnings growth, fueled by this AI revolution, is expected to shift into an even higher gear. So if you look at it this way, the stock almost looks like a bargain compared to its own recent history. Okay, so this is the real head scratcher, right? We have two totally valid, smart ways of analyzing the exact same company, and they're spitting out wildly different conclusions. One says it's overvalued, the other says it could double. So how is that even possible? And this chart really shows why that PE ratio tells such a different story. If we look at current earnings, not future ones, Nvidia's PE is 37. Well, that's actually lower than the average for US semiconductor companies, and it's way, way below its peer group average. So when you actually compare it to the rest of the market, its price tag doesn't look stretched at all. You could even argue it's on sale. So really what we're looking at here are two completely different philosophies of value. That fair value model, it's like an architect's blueprint. It's trying to build a detailed forecast of the future based on all these complex assumptions. The PE ratio, on the other hand, it's more like a quick snapshot. It's a relative price tag. It just tells you what you're paying right now compared to earnings and compared to its neighbors. One's a prediction, the other's a comparison.
So, who's right? Which story should you believe? Well, the answer isn't simple, of course, but the source material does point to a few key things that everyone should probably be watching to see how this all plays out. So, what do we keep our eyes on? Well, the cautious, overvalued case wins out if some serious competition finally shows up, or maybe if new regulations on AI or power usage start to slow things down. The bull case, on the other hand, it really depends on this massive AI infrastructure build-out continuing at this insane pace. But the real wild card here, it might just be investor sentiment. Plain and simple. If the market wakes up one day and decides Nvidia deserves that old price tag of 45 times earnings again, the stock could shoot up, potentially doubling, without a single fundamental thing changing about the business itself. And so that's where we're left, with this absolutely fascinating puzzle. The technology is undeniably changing our world. But how we put a price tag on that change, well, that's a tug of war between two very different stories. One is a complex blueprint for the future, the other is a simple snapshot of today. The big question is, which story do you think makes more sense? What a fascinating time to be watching all this unfold.